Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. I'll be talking to our Head of Research, Jasper Lawler, to discuss US tech and social media company earnings, oil company earnings, what Draghi might say about tapering at the ECB meeting, and UK third quarter GDP data and what it means for the pound. First, let's highlight some key earnings and economic data for the week. So starting with corporate results, there are a lot of US companies reporting third quarter earnings, so we've picked out some highlights. Seagate Technology on Monday, Biogen, United Technology, 3M, General Motors, Caterpillar and McDonald's on Tuesday, Lloyds, GlaxoSmithKline, Visa, Coca-Cola, Boeing and Equifax on Wednesday, Barclays, Deutsche Bank, Amazon, Microsoft, Twitter, Intel and Google owner Alphabet on Thursday. Then we finish the week with RBS, UBS, Volkswagen, Total, Shire, Exxon and Chevron on Friday. Moving on to the economic calendar. It's a slow start on Monday, but on Tuesday we have Eurozone services and manufacturing PMIs. On Wednesday, German IFO, UK third quarter GDP, US durable goods and the Bank of Canada rate decision. On Thursday, it's the ECB monetary policy statement and press conference. And finally, US third quarter GDP on Friday. So Jasper, a lot of big tech companies reporting their earnings next week. How important are they?
Well, they are important because technology is the best performing sector. So when you're looking in the US, you look at the S&P 500, for example, XLK, which is the S&P 500 technology ETF. That's the best performing sector ETF in the US this year to date. It's up 25%. The S&P 500 by itself is up 14%. So it's obviously tech stocks are outperforming, so they're leading the market. So typically what you'll see is that if there is going to be some wider market decline, it will be those leaders that lead the decline because they led the advance in the first place. So from that standpoint, they are. But I would say maybe they are less important than they once were, just because at some point it was almost five stocks that were driving the entire market's gains, like these top technology stocks. But the gains have been a bit more broad-based this year. For example, healthcare, has been performing very well, most of the sectors are higher. So from that standpoint, maybe they're slightly less important than they once were, but obviously they're big movers as well on these earnings typically. So because they're so highly priced, you can obviously get big gratification, big disappointment, generally means big volatile price moves.
Yeah, thanks. So also we've got three of the oil majors reporting next week. What do you think? What's your outlook on that?
So interestingly, energy was the only one of the 10 major S&P 500 sectors that's down for the year. It's down 10%. It was actually down more, but there's been quite a rebound since August. I would pretty much pinpoint that around being August was about when we jumped back through $50 a barrel in Brent. And so I think they've been tracking oil prices higher. But actually, looking at Brent crude, that's flat on the year. Whereas the oil sector as a group is down 10%. So obviously the shares are underperforming the commodity at the moment. So I would expect that balance to be redressed, and whether it happens sooner rather than later probably is dependent on these earnings. Generally, the earnings are looking better because oil prices are more stable, but people are looking for growth rather than stability, obviously.
Of course. And we've got the big ECB meeting next week as well, or this week. How does Draghi tackle the tapering, the tapering question?
Yeah, so I mean, it's a huge deal actually, because obviously a lot of the stock market gains we know are hinged on the low interest rate environment, the bond purchases. So the Fed have already started the process of selling off their bonds. The ECB are very slowly starting their process of doing the same, and this meeting is actually a big inflection point for that. I think the general expectation is that they will announce some sort of tapering. So you remember that they were buying 80 billion euros a month. Now they're buying 60 billion a month. But when they announced the drop to 60 billion, they extended the program by 9 months. So it would make sense if they're being consistent to extend the program by 9 months again. If they extended it by 12 months, that would be a bit of a dovish tilt, I think, and that would maybe send the euro lower. And then obviously the other factor is, well, how much do they taper it by? I think the general sense is going to be something between the 20 to 40 billion kind of range. 40 billion would again be a bit less than maybe the consensus, so that would be a bit dovish. If it was more like, if they cut it right down to 20 billion a month, I would say that's a bit more hawkish. So maybe 20 billion and 9 months would be the kind of hawkish end, more like 40 billion and 12 months would be on the kind of dovish end of the scale. And then added to that, it's just how they coax it in terms of their expectations. If Draghi says in his press conference, okay, we're doing this, but we still leave the program open to extending it beyond, say, whatever it is, September or December next year, then again, you know the program could keep going. So that all that does is push out the kind of expectation for when the ECB will finally start hiking rates. Probably sometimes in 2019, but whether it's the start or the end will affect probably the euro's performance.
Yeah, okay. And we have UK GDP this week as well. What are the expectations and how does it fit into overall when looking at the pound?
Well, so the actual numbers, we're expecting 0.3% quarter over quarter, that's unchanged. And so we're expecting 1.5% year over year. That is also unchanged. So obviously not a massive game changer there. The numbers are going to be the same. So for the pound, at the moment, it's been a little bit beaten down. And I think it's just because this no-deal Brexit scenario is kind of weighing on it more than the economic data, which is basically unchanged. I think probably more interestingly than the than the UK GDP is the US GDP, where actually we were at 3.1% year over year last quarter. We're looking at a drop now towards maybe 2.5%. Basically, just a residual from the loss of activity during the hurricanes. So it's expected to be short term, but we'll have to see how much damage these hurricanes have done. And going forward, though, I still think that probably a combination of spending money on rebuilding after the hurricanes, and also we had the Senate pass the budget bill in the US, and that's paving the way to Trump's tax plans. If that's more growth, then obviously, then the US can bounce back from any short-term blip.
Yeah. Thank you very much, Jasper, and thank you all for watching. If you wish to get these videos as they're released, please follow LCG on social media.